let's touch on that profit warning that we saw coming through from British American. The stock didn't trade on the back of that, but you know, some bad news for the company, where analysts were seeing earnings flat for 2011 from 2010, where it returned to profitability. It just shows how volatile the markets are right now.
Exactly, it's really volatile, but primarily for British American, which has over 60% of its portfolio in equities, and given the performance of the equity market last year, it was obviously going to have an effect, and especially through counters like Equity Bank and HFCK, which have dropped significantly over the year. So that was going to hurt them. And I think it's going to hurt insurers as well, because a lot of insurers are heavily exposed to the equities market. And some of the valuation gains that were made in 2010 are likely to be reversed this year across the board, not only for British American investments. Are
insurers repositioning their portfolios then to reduce their exposure to the equity market, which has been on this bearish trend for some time now?
Yeah, a number of insurers are moving more into property, which is seen as a more stable asset class, and given that a lot of their income is valuation gains or losses, then property is likely to have a good effect on their valuation gains going forward. So I think a lot of insurers are moving now into property to stabilize those gains.
Now, one sector that is expected to perform relatively well in 2012 is the agricultural sector. We know how well it did last year. Looking at the first coffee and tea auctions yesterday, we had coffee prices which slipped back, tea prices rising marginally. But overall, what is your feeling with regards to where these soft commodity prices are going to go in 2012?
For one thing, I think the outlook depends on two factors. One is the rainfall for this year. At least we had the good October, November, December rains, and that's likely to have a positive impact on tea, in industrial crop production. And going forward, the second factor that's going to have an effect is the European debt crisis and the effect on the European economic growth. At least for tea, we are seeing that there's a more diversification towards the Asian markets, and therefore tea prices are likely to stay strong and stay at their current levels. But for coffee, given that a lot of it goes to Europe, then the outlook is heavily hinged on what happens in Europe this year. But I'm positive that the tea prices will stay strong for 2012.
And a sign of really that dipping demand is the demand in the tea auction yesterday, where demand from the UK slipped back. Which stocks particularly would you be bullish on and buying into in the agricultural sector if you're expecting a relatively good performance?
I mean, with regards to performance, and it's those ones that are more towards the tea market, and such as Williamson Tea and even Sassini. But overall, I think that there's a lot of factors that could affect their performances, including the general market sentiment and liquidity. But I think Williamson and Sassini would be decent bets on the agricultural counters.
Of course, a big focus for the market today is the MPC decision. The general expectation is for interest rates to be kept on hold. But just reading one of the analyst research notes, they were saying that we might see a slight increase in the CBR because previous rate hikes haven't fully penetrated the economy yet. You've still got inflation, which is high. It has been coming down. The shilling has not yet stabilized. What are your views in terms of whether we've reached the peak of the interest rate hiking cycle?
For one, the effect of the CBR is not, you are not supposed to see it immediately. There's obviously going to be a lag in headline inflation figures, and in Kenya historically it has been a 9-month lag, more than 6-month lag. So in terms of headline inflation, we are likely to see headline inflation figures coming down at around June this year. The key thing is that have they managed to contain inflationary expectations? To this end, I think they have. And if you look at, I mean, the general market sentiment is that inflation is peaking, and going forward that we're likely to see a gradual decline in inflation figures. So from that perspective, there's not much of a rationale for increasing the rate hike. However, this year there's been a lot of, the rhetoric from the MPC has been varied. In the beginning of the year, they were talking about sustaining growth, the growth momentum. Mid this year, they're talking about keeping net domestic asset targets, and by the end of the year, they're talking about inflation and exchange rate pressures. So we don't know what variables they're going to focus on this time round. But in my view, I don't think a rate hike is necessary at the moment because inflationary expectations have been contained, in my view.
Yeah, and we saw inflation numbers coming through for Ethiopia. So generally in the region, inflation is ticking down. Just your views on the general investment environment right now, with a lot of scenarios being tabled with regards to where Europe is going. On the one hand, you've got a possible recession, and investors or analysts saying that we could see growth between 3 and 3.5% as a result of a recession taking place in Europe. On the other end, if debt problems are resolved there, you've got growth forecast between 5.5% and 6%. How does this impact your investment strategy right now?
I think the key thing is that to look at what is likely to go wrong and what is likely to go well. And I think the odds are stacked against things going wrong this year in Europe, and the likely effects on the Chinese economy and emerging markets, as well as North America. So for this year, I think the focus should be on capital preservation, because there's a lot that can go wrong this year. And I think to that end, probably the best investment strategy is to preserve your capital through fixed income in the stock exchange, which is already giving a good positive return if you project inflation figures to be lower this year, as well as defensive stocks that, defensive stocks with good corporate governance standards for exposure to the equities market.
Those defensive stocks, which one stands out for you as key ones to be looking at?
I think for one, British American tobacco would be a defensive stock, as well as East African breweries. I think if you look at the November leading indicators by the Kenyan National Bureau of Statistics, beer production was relatively good compared to last year, and British American people are still going to smoke, maybe even more so given that the economy is performing badly. So I think those two stocks, as well as maybe KCB and equity in the banking sector.
So the sin taxes really stand out for you. The sin stocks rather stand out for you. Samora, exactly. We'll leave it on that. Samora Kariuki, research analyst from NIC Securities.